Gold investors, welcome back. If you've been watching the charts this week, you know we just witnessed one of the most violent shakes in the history of the precious metals market. Just 48 hours ago, headlines were screaming that the gold bull market was dead. We saw a staggering 9% plunge, the worst 5-session performance since 1983, sending spot gold crashing to a 4-month low of $4,098. But as of today, Wednesday, March 25, 2026, the script has flipped. Gold is surging, recovering over $450 from those lows to trade back around the $4,560 mark. Is this a dead cat bounce, or have we just seen the ultimate bear trap before a run to $5,000? In today's video, we are breaking down the geopolitical Trump pivot, the death of the 2026 rate cut hopes, and the technical levels you need to watch to survive this volatility. Section 1. The macro shock. Why did gold crash? 1:30 to 4 o'clock. To understand where gold is going, we have to look at why it collapsed. Usually, war equals higher gold prices. However, the escalation in the Middle East did something unexpected. It sent oil prices up 60%. This created a massive inflationary tax. While gold is an inflation hedge, it's also highly sensitive to real yields. Because oil prices spiked, the markets panicked that inflation would become sticky again. As a result, the Federal Reserve's path for 2026 has been completely repriced. On February 27, the market was 96% sure we'd see rate cuts. Today, that probability has collapsed to nearly 0%. When the market realized that interest rates are staying higher for longer, to fight energy-driven inflation, the opportunity cost of holding gold, which pays no interest, became too high. Investors dumped bullion for the safety of high-yielding U.S. Treasuries, driving the dollar to a yearly peak and gold to that terrifying $4,100 level. Section 2. The Trump pivot and the Wednesday recovery. 4 o'clock to 6:30. So, what changed in the last 24 hours? 2 words. Geopolitical de-escalation. President Trump's announcement of a 5-day postponement of planned strikes on Iranian energy infrastructure acted as a pressure valve for the markets. The war premium that had shifted into oil started to leak back into equities and gold. But more importantly, the selling simply ran out of steam. We saw a massive hammer reversal pattern on the daily charts. On Monday and Tuesday, every time gold dipped toward the $4,100 zone, institutional buyers stepped in. This tells us that despite the hawkish Fed, there is still a massive floor under gold provided by central banks. Even with prices at historic highs, central banks are expected to purchase over 750 tons of gold in 2026. They aren't looking at the daily noise, they are diversifying away from the dollar, and that is providing the liquidity needed for this $400 recovery. Section 3. Technical analysis, the next move. 6:30 to 8:30. Let's look at the levels. Technically, the bias remains cautious as long as we are below $4,500, but today's move above that handle is a huge statement of strength. The support. The 200-day moving average at $4,200 is now the line in the sand. As long as we stay above this, the long-term bull trend started in 2025 is still alive. The resistance. We are currently facing a ceiling at $4,665. This was the level that rejected the price in early February. If we can close the week above $4,700, the path clears for a retest of the all-time high zone near $5,600. The moonshot. Some analysts, including those at Saxo Bank and independent technical researchers, are looking at Fibonacci extensions. If this recovery holds, the 100% extension targets sit at $7,000, with extreme, black swan, forecasts reaching as high as $9,000 by late 2026 if geopolitical tensions reignite. Section 4. Bank predictions. Where will we end 2026? 8:30 to 11 o'clock. What are the big boys saying? The institutional consensus is surprisingly bullish despite the recent crash. J.P. Morgan is maintaining a target of $6,300 by year-end, citing private sector diversification. UBS and Deutsche Bank are both clustering around the $6,000 to $6,200 mark. The Reuters poll median, which averages 30 top analysts, sits more conservatively at $4,746. The takeaway here is that while the easy money in gold was made during the 2025 rally, the 2026 landscape is about volatility. We are in a high inflation, high interest rate environment, which is a tug of war for gold. Every dip is being bought by central banks, but every rally is being capped by the Federal Reserve's hawkish stance. Conclusion. How to trade this. 11 o'clock to 1300. The next move for gold depends entirely on the U.S. dollar index DXY and energy prices. If oil stabilizes and the Fed signals even a tiny bit of dovishness, gold could easily sprint back to $5,000. However, if we break back below $4,300, we might be looking at a much deeper correction toward $3,800. For now, the hammer is in, the reversal is real, and the $4,100 support has proven to be an iron floor. Stay disciplined, watch those yields, and don't let the 5-minute charts scare you out of a 5-year trend. Would you like me to generate a script for the intro and outro of this video specifically tailored to your YouTube channel name?